The government gave you a crucial choice to make this year: the old tax regime or the new one. Most people picked the new one because their HR department said it was simpler. Some picked the old one because their accountant said it saves more immediate tax. Approaching this purely as a math equation on a tax form is a mistake. This is actually a wealth question, and the right answer hinges on a psychological variable nobody warns you about. If you select a regime simply because it requires less paperwork, you risk losing millions of rupees from your future net worth. Viewing your tax regime as a routine checkbox means overlooking the subtle design features that change your financial trajectory. Let's look at how the mechanics actually work. The old tax regime calculates your total income, but allows you to reduce that taxable base. EPF, ELSS, and PPF systematically chip away at what the government can tax. The new regime takes a different approach. It drops the base tax rates, but removes those deductions. No receipts required. On paper, that looks like a clean administrative upgrade, but the side effect is that it removes the pressure to invest. The danger of this simplicity is that it quietly grants you permission to skip foundational wealth-building investments entirely. To see how this plays out, take someone earning a salary of 8 lakh rupees a year. This chart compares the immediate tax output. In the old regime, with standard deductions and basic ADC investments, your tax sits around 31,200 rupees. In the new regime, it drops to about 15,000. That leaves an extra 1,350 rupees in your pocket every month. But that extra cash introduces a psychological trap. It becomes unearmarked money, money sitting in your account without a specific job. When money lacks a strict assignment, it typically gets absorbed by lifestyle creep. It gets spent within the same month it arrives. The old regime actively prevented this. It routed that money into your EPF or mutual funds before you could spend it. Gaining short-term lifestyle liquidity through the new regime usually results in an automatic sacrifice of long-term wealth accumulation. This line chart projects what happens if you strictly invest that $1,350 monthly difference. Over 25 years at a 12% return, it grows into 22.8 lakh rupees. Now factor in the hidden loss, the ELSS and NPS contributions you stopped making. That's easily another 2,000 to 4,000 rupees disappearing into daily spending. Add those abandoned investments, and the total projected lost wealth sits between 35 and 50 lakh rupees. Your tax savings for switching was about $16,200 a year. The multi-decade cost of that convenience was roughly 43 lakh rupees. The regime that saves you the most immediate tax is often the one that destroys your future wealth potential. Look closely at the 1.5 lakh rupee limit of the old regime's ADC deduction. Break that bureaucratic limit down mathematically, and it operates as a mandatory $12,500 monthly investment plan. Interacting with ADC is not a compliance chore. It is the government tricking citizens into building a formidable asset portfolio. The new regime removes this benevolent structural pressure. For most earners, the administrative friction of the old regime is its most valuable wealth-protecting feature. Making the correct choice requires shifting your focus away from the tax math and honestly assessing your behavioral profile. Profile 1 is the disciplined optimizer. You track your cash flow, run automated investments, and stick to a defined budget. The optimizer is the only profile that safely benefits from the new regime. You take the liquidity and manually invest the difference without sacrificing future wealth. Profile 2 is the average earner. Statistically, if extra cash hits your bank account, you are prone to spending it. This flowchart is the ultimate decision. If your take-home goes up by a few thousand rupees, ask yourself what happens next. If you will probably spend it, you require the old regime as a forced behavioral guardrail. The government has functionally provided two distinct financial personalities to adopt. The test of a tax regime is not how much tax it cuts today, but how it engineers a wealthier you in 20 years. Before you open the tax portal this year, make an honest assessment of your own financial discipline. Share this behavioral framework with any young earner you know who is about to submit their first HR form. Long-term wealth is a psychological design choice.